What's up guys, welcome to the channel. In today's video I have got a how to invest in stocks for beginners course where I'm pretty much going to share with you guys pretty much everything you need to know in order to get started investing into the stock market. Now in order to be able to do this I have prepared a little bit of a presentation for you guys where I'm going to pretty much run through lots of different topics which we'll run into in a little bit more detail in just a moment's time. Now what I did want to say guys, just at the top of the video, this is a completely free course. All I ask is that you just drop a like on the video if you enjoy this kind of content and if you found value in the video as well. There's no kind of upsells whatsoever down in the description at all. So with that said, let's dive into the content and share with you guys what I'm hopefully going to be able to teach you throughout the course of today's video. So let's dive into it. What have we got on the agenda for today's video? Well, there's quite a lot to go through and I'm not going to go through all of these ones individually now, but in essence, we're going to talk about what actually is the stock market, how you can invest in stocks, how you can actually make money from investing into stocks, some investment strategies which I personally use, as well as we'll compare them to some other investment strategies out there as well. And we'll also talk about the importance of investing early into the stock market in order to benefit the most and grow your wealth over time. So that's in a nutshell what we're going to talk about. Obviously, you've got all of the agenda items down on the left-hand side. And of course, I have nothing to say you at the end of this video either. So let's dive into the first slide, which is why should you invest? Now, the first predominant reason is simply down to growing your wealth over time. That's why most people invest. It's why I invest into the stock market, to simply grow my wealth. Now, over on the bottom left-hand side of the screen, you can see the S&P 500 index and the historical performance that it's actually been able to generate over the course of the past decade. Now, for now, I don't want to talk too much in detail about what exactly the S&P 500 index is, because we'll talk a little bit about that a little bit later on in the video. But what I did want to focus on is the actual return on investment that the S&P 500 has provided. So over on the right hand side, you guys can see over the course of the past 10 years, over those 10 years, we've had 8 winning years, we've had 2 losing years, and the best winning year was a return on investment of 29.6%, and the worst losing year was just negative 6.24%. However, over the course of a 10-year period, when you're investing over the course of the long term, that 10-year period actually provided a total return on investment of 140.57%, which when converted into a compounded annual growth rate, is 9.15% as an average annual rate of return. Now, the reason why that number is so important is because most people typically have their money sat in their bank account, held in cash, getting them probably next to nothing in interest as of the current climate in which we're in. Whereas if you compare that to returns which you can get from the stock market being, upwards of 9% per year just on an average annual basis, then that's the big differential between why some people can actually make a hell of a lot of money over the course of their lifetime simply through investing versus the people who don't, because they simply have all of their money saved in cash and it's never invested throughout the course of their lifetime. So in a nutshell, the first reason why you should start investing is to simply get your money working for you. And the second part to why you should invest is pretty much the reason why, because investing into the stock market is simply another way to hedge against inflation. And what I mean by that is inflation is typically when the price of goods go up year in, year out. Now, as of in the UK currently, inflation is very, very high at 5.1%. However, the Bank of England base rate is just 0.25% and the interest on your bank account is probably just 0.1%. So if you think about inflation being the increase in the price of goods year on year, however, your interest on your money is only going up by 0.1% per year. Well, that means your money is actually being eroded based on current inflation rates, which you can see over on the left-hand side, of about 5% per year, which is absolutely massive. If we kind of provide some context to that, a simple £10,000 held in cash in 2020, as of 2021, would only actually be worth £9,500 in purchasing power today. So whilst the physical number in your bank account doesn't go down, it's the purchasing power that does decline, and therefore it's a little bit of an invisible erosion of your wealth, which typically people don't see. So because of that, investing into the stock market, as I said, still outperforms these very, very historically high levels of inflation which we're experiencing in the UK currently, and actually grows your wealth over time and acts as a perfect hedge against inflation and your money being eroded. So they are the two predominant reasons why you should simply look to invest pretty much as soon as you possibly can. So with that out of the way, now let's dive into what actually is the stock market, and we'll start to dive into a little bit more of the technical details surrounding the stock market and investing in itself. So the stock market is simply a place where investors buy and sell shares of publicly traded companies. It's regulated by the FCA, which is the Financial Conduct Authority over here in the UK, or over in the United States, it's regulated by the SEC, which is the Securities and Exchange Commission. Now, you may be asking, why on earth would a publicly traded company actually sell shares and essentially ownership in the business to investors like me and you? And the simple answer is, in return for receiving those shares, in essence, they get capital invested back into the business, which they can then go and reinvest in the business itself in order to help the business grow over time. Now, in terms of where these publicly listed companies are actually listed, well, there are 60 stock exchanges all around the world, including some common ones which you've probably heard of before, like the London Stock Exchange, the New York Stock Exchange, or the Shanghai Stock Exchange. And in essence, retail and institutional investors can buy and sell shares on any of these exchanges to create an investment portfolio. So talking of investments and an investment portfolio, well, what exactly are stocks? Well, essentially, stocks are where investors can obtain part ownership in a company through the purchase of shares. If a company like Tesla had 100 shares and you bought 10 shares of that company, you would own 10% of Tesla. Now, obviously, that's a little bit hypothetical because obviously the number of shares in circulation for Tesla are far more than just 100. However, that's just to keep it simple and give you guys a little bit of an understanding of how it all works. And in essence, the more shares in which you own in a company, the higher the percentage of ownership in which you have. So if you look at kind of Warren Buffett's investment portfolio, you'll be able to see, because of how much money he actually has and how much money he's invested into quite a few businesses, he's actually been able to acquire quite a significant amount in terms of the percentage ownership in some of these large mega cap stocks in which he's invested into. Now, when we talk about the value of a business, we typically refer to it as market capitalization, which is essentially the function of shares in circulation multiplied by the stock price, which essentially defines the value of a stock. And each stock is listed on a stock exchange, e.g. the London Stock Exchange, with a ticker symbol. Now, I've used examples for United States-based companies, so they are not actually listed on the London Stock Exchange, but you kind of get the picture. So we've got Tesla with the ticker symbol TSLA, Apple with the ticker symbol AAPL, and Microsoft with the ticker symbol MSFT. So now we know a little bit more about stocks and exactly what they are and how we can invest into them. How do we actually make money from investing into stocks? Well, the first thing is share price appreciation. It's essentially an increase in the price of the shares in which you own. When you look to buy perhaps one share of Tesla for $500, and let's say today Tesla trades at $950, then if you decided to go on to sell that share, in essence, the profit is the difference between the price in which you paid for the share versus that of the current market price today. So in this hypothetical example, $950 minus the $500 initial investment would net you off a $450 profit. And as you guys can see over on the right hand side, I've kind of highlighted Tesla's current market price and how it's performed over the course of the past 12 months. And you can see it's provided a 1-year return on investment of 53.15% and has actually gone up in value to the tune of $340. So that's the first way in order to make money from the stock market. But there is also alternative ways in which you can make money, which leads me on to the second point, which is about dividend payments. Now, dividends are something that some companies pay, which in essence is just a distribution of the company's profits back to its shareholders. And in essence, the more shares in which you own, the higher the dividend in which you'll receive. Typically, it's expressed as a per share amount, for example, 42 cents payable each quarter. And over on the right hand side, what I've done is provided a screenshot of Coca-Cola's dividend history. Now, Coca-Cola have paid dividends for decades and decades and decades consecutively, and you can see over on the right hand side under the amount column, they've consecutively increased that dividend over time as well. So as of kind of the 2019 mark, they were paying a 40-cent dividend per quarter. By 2020, it was 41 cents, and now in 2021, it's now 42 cents. So in terms of how much you could actually make in, I guess, kind of passive income, if you like, from investing into Coca-Cola stock, well, if you purchase 1,000 shares of Coca-Cola, you would get $42 per quarter in dividends, the equivalent to $168 per year. Now, before we actually dive into investing into the stock market head first, and before you go on to invest into any kind of stocks whatsoever, it's firstly wise to be kind of mindful of what type of investor are you. And that will largely depend upon 3 different things. Your risk appetite, for example, how much risk are you prepared to take? What is your tolerance for drawdown on your investment portfolio or even potential loss? Then secondly, what are your investment objectives? What's your desired outcome? Is it retirement? Is it kind of passive income? Or is it simply capital gains? And then the third point to make is that personal circumstances will heavily dictate your kind of investment approach and kind of how you approach investing on the whole. So whether you're rich or poor, young or old, an active investor or a passive investor, those kind of criteria, and obviously they're not an exhaustive piece of criteria, but those pieces of criteria will certainly help you kind of define your overall investment strategy and how you want to invest over the course of the long term. Now, once you've kind of decided what kind of investor that you are, the next thing that you're probably going to want to think about is the different account types which are available to you. Now, these account types are just available for us over here in the UK. These are not available over in the United States. They do have United States equivalents, but I won't go into those in any kind of detail during this video. But the two different accounts that we typically have available to us over here in the UK is a stocks and shares ISA, which is essentially tax-free investing, where you can invest up to £20,000 per year. And it's usually free to open these kind of accounts, but do bear in mind that some brokers will charge. And the second type of account is just a general investing account. It has pretty much all of the same functionality as a stocks and shares ISA in terms of what you can actually invest into. But do bear in mind that it is subject to capital gains tax. But however, you can make unlimited investments into that kind of general account, whereas obviously the ISA is capped at £20,000 per year. And then similarly, the general account is usually free, but again, some brokers can charge for doing so. Now, what I must also reiterate is when you open a stocks and shares ISA, you can only actually actively invest into one stocks and shares ISA per tax year. You can't just open lots of different ISA accounts and kind of have £20,000 allocated per ISA in which you have. It's only one ISA that you're allowed per tax year, and it's only £20,000 per year which you can actually invest. So it's probably worthwhile me just calling that out whilst we're talking about the different account types that are available. The next thing that you're then going to probably want to decide is the different brokerages which are available to you and which ones in which you actually want to use. So I've just provided a few different ones up on screen. So we've got the likes of Free Trade and Trading 212, as well as Vanguard, which are kind of the key ones over in the UK, as well as Hargreaves Lansdown, as well as Stake. There are the popular ones over here in the UK. Whereas if you're watching this over in the United States, you've got apps like Robinhood, as well as M1 Finance too. Now, for me personally, I have used and currently use, as of right now, Free Trade, Trading 212, and Vanguard. I have no experience whatsoever in any of these other apps which are up on screen, but Free Trade, Trading 212, and Vanguard are the ones in which I've personally used. So in light of that, I thought we'd kind of pause the presentation now, and actually I'd give you guys a little bit of a rundown of both Trading 212, and we'll also discuss Vanguard and do a little bit of a tutorial. I'll show you my investment portfolio as well, and we'll kind of dig into it in a little bit more detail. So up on screen, guys, this is the Trading 212 mobile app which I'm using. So let's just go through the app in a little bit more detail and all of kind of functionality behind it. So first up, let me just show you my investment portfolio, which you can see at the top of the screen, a portfolio value of £26,622, of which I've invested just shy of £20,000 with a return on investment of £6,665, the equivalent to 33.4%. And I've had this account for about probably just over a year now, I'm going to say, that I've been using Trading 212 for. Now, you can also kind of go onto the different time frames in terms of to look at the overall performance of that portfolio, and you can kind of drag the little kind of ticker, if you like, all the way across your portfolio to see the change in the value of that portfolio over time. And you can see how much my investment portfolio has fluctuated from kind of all-time highs, I think probably a little bit earlier on this month, where we were up probably about just over £7,000, and we're down a little bit from that point in time, but nonetheless still very much in the green. Then as I go through just some of my investments, I'm not going to go through them all in detail, but you can see some of them are very much in the green. Some of them are currently sat in the red. Growth stocks, unfortunately, have been hammered over the course of past few weeks or so. So we're sat in the red on a couple of different stocks in the portfolio. But at the bottom of the portfolio, you can also see my total investment allocation. So if I just click on that, it gives you a breakdown of the portfolio and the percentage allocation in which you have towards each stock or perhaps even ETF within that portfolio. So for now, you can see I've got 22% in Apple, 20.8% in Tesla, 14% in Amazon, 12% in Meta, and you kind of get the picture. So that's kind of the portfolio view, if you like. Now, in terms of just, I guess, searching for different stocks on the app itself, it's pretty intuitive. It's pretty easy to use. At the top of the screen, you've got stocks as well as ETFs as well. So let's just take a look at stocks for now. You can see that it's kind of broken down into most popular, dividend, growth, high volatility, low volatility, and then speculative stocks, or you can just simply browse all of the stocks on the app, of which there are 7,533 companies available to invest in. Let's just take a look at the most popular. So you can see all of the different stocks over on the screen at the moment. And simply to, I guess, invest into a stock itself, if I just click onto Advanced Micro Devices, it's pretty simple. Because I have AMD within my investment portfolio, I have the option to sell as well as buy. But for now, just to kind of give you guys an example, if I were to buy shares in AMD, you simply click on the buy button, and then you can scroll this little toggle all the way across to kind of buy, even a fraction of a share or one whole share. It really doesn't matter, which is kind of another good thing about the app, is the fact that they do offer fractional shares. So if you say didn't want to invest a full £110 into AMD, you perhaps could do 0.6 of a share, or you can actually just edit this and do 0.5 of a share as well, which would be £55 instead. So that is, and then you would click on review order, go through. I'm not going to invest now, but you could just simply do that quite easily and go through the motions. In terms of, I guess, just additional things on the apps, well, you've got a bit of a social where you can see different threads and different news articles and all that kind of good stuff. Interact with different people within the community as well, which, depending on what you're interested in, might be something of use to you. And then other than that, that's pretty much about it. Obviously, you've got plenty of different stocks on here which you can invest into, but that's pretty much how you use the Trading 2 on 2 app in a nutshell. So that's Trading 2 on 2. Now let's take a look at Vanguard and do a little bit of a tutorial of how you can actually use Vanguard UK if that's the preferred choice of broker for you. Now, Vanguard itself, probably the key thing to call out is I'm just going to click on their full list of funds, because Vanguard actually just solely provide their own list of diversified funds and ETFs which you can invest into. So if you do open an account with Vanguard, you can't actually invest into individual stocks. So as an example, you can't invest into Apple or Tesla or Microsoft or any of the kind of popular stocks out there. And instead, they have a very specific list of funds which they actually offer to their clients. So I've brought up the full list of funds here. So they have life strategy funds is probably the first one to discuss, where it's basically a split between equity and bonds, depending on how aggressive you want to go within your investment portfolio. Will probably depend upon your allocation. The more aggressive you obviously are, the kind of higher weighting you'll probably end up going towards equity versus that of bonds. And what I also like about Vanguard, you can see over on the right hand side, each ETF and each fund has a risk rating, which I guess kind of you can align to your overall risk appetite. Obviously, you don't want to go too high risk if you're very much a conservative investor, or if you're a little bit more like me and you've got a little bit more of a higher tolerance for risk, perhaps you could invest into funds that are a little bit higher up on that risk spectrum. Now, what I wanted to show you guys is just the simple fact that there's so many funds on here, lots of different funds for pretty much every single investor and every type of investor, from kind of FTSE funds. But the one in which I wanted to focus on, because I did briefly touch upon it at the top of the video, is the S&P 500 index, or in this case, the S&P 500 ETF. The reason why I wanted to touch on this is because it's one of the probably better performing ETFs which actually are available over on the Vanguard website. It's something which I'm personally invested into, and because of that, I feel far more comfortable talking about something which I have personally invested into. But in essence, the S&P 500 is simply just a collection of the top 500 companies in the United States of America, and the ETF itself simply tracks the overall performance of the broader S&P 500 index. Now, what I wanted to do is just kind of show you the overall makeup of the S&P 500, where your money's invested and what your money's actually invested into, and how it all kind of works. So over on, I guess let's just talk about it quite briefly then. So the market price, you can buy 1 unit of this ETF today for £66.89. In terms of the number of stocks in which you're going to invest into, it's 509 stocks in total. And I know I just said there's 500 companies in the S&P 500. That is still factually correct, but some companies like Alphabet, as an example, do have 2 different shares in which you can buy, where they have, I think it's Class A stock and Class C stock, which they have available. We'll look into the portfolio data in a little bit more detail in just a moment's time. The next thing to call out is the ongoing charge, the OCF, which is just 0.07%. That's another really important thing to understand when you're investing, is to actually actively take a look at the charges of the funds in which you're investing into. The reason being, if you are investing into a fund that's, say, like 0.75% in interest, whilst it probably doesn't seem like a huge amount, that will really, really eat into your overall investment returns over the course of the long term. So because of that, ideally, you want to be looking at funds which have the lowest ongoing charge rate that's available basically to you, because obviously that's favorable for you as an investor who's looking for a return on your money. The next thing to call out is the risk rating, which is currently 5 out of 7. So it's a little bit higher up on the overall risk spectrum, with obviously the lowest risk being 1 and the highest risk being 7. So let's talk a little bit more about the detail of the S&P 500 index, or the S&P 500 ETF. You can see the overall performance of this fund over the course of the past 5 years or so, since 2016, and it's performed pretty phenomenally. And I think this is probably where it also highlights the major differences between investing, or kind of just having your money in cash in a bank account and the interest rate which you're getting, versus that of investing your money and getting kind of 22% in 2016, an additional 5.6% in 2017, another 15.5% in 2018, another 16.8% in 2020, and then another 27% in 2021. So these returns are pretty phenomenal, and very much outstrip any kind of returns which you could get in interest in your bank account. And that's why I personally invest into the S&P 500 as a big chunk within my investment portfolio. And you can see how that kind of would result in, if you just made a simple £10,000 lump sum investment in 2016, well, as of today, you would have more than doubled your money. So that's kind of that at a very high level. In terms of a little bit more detail, though, which I wanted to go into, we've kind of discussed the performance. Just going on to the portfolio data tab, it also gives you a little bit more of an insight into some of the quantitative analysis factors which you might go on to do, which I'll discuss in a little bit more detail later on in the video. But it talks about things like the price to earnings ratio, price to book, return on equity, and earnings growth rate, which we'll discuss in a little bit more detail later on in the video. And I explain exactly what these kind of metrics are and how we can actually use them to make informed investment decisions. What I want to touch on a little bit more is just kind of the overall breakdown of the ETF itself. So you can see it's very, very diversified across all of the major sectors, across the economy, from IT to consumer discretionary, from healthcare, financials, and the list goes on. So you've got a very diversified investment just by investing into the S&P 500, with lots of different stocks in lots of different sectors. And because of that, let's say, for example, one specific stock within this portfolio itself doesn't perform all too well, you've got another 499 other stocks within the S&P 500, which can certainly still perform well and still bring up the total value of your portfolio. And that's a really important point to make when it comes to diversification and having a fully diversified portfolio. On top of that, it's probably worthwhile me also saying the S&P 500 itself as a fund, as an index, is actually reviewed on a quarterly basis. So, and again, this is another reason why I like to invest into the S&P 500, is simply down to the fact that because it's reviewed quarterly, that means the worst performing firms in the S&P 500 drop out of the index, and then the up and coming firms, if you like, then get added into the index. So it means at any given point in time, you have complete access and exposure to the top 500 companies in the United States of America, which is a pretty powerful investment to have when you consider how much of a global powerhouse the United States is, especially when you consider, pretty much all of the big major market capitalization companies are pretty much all US-based companies. So let's look at the distributions in a little bit more detail. For those of you guys who are interested in actually getting a little bit of a dividend, it's not the biggest paying dividend, but you can see you do get a small dividend of 1.08%, on a quarterly basis, which is pretty sound to get that dividend every single quarter. That's the S&P 500 in a nutshell. That's kind of the Vanguard platform. As I said, there's tons of different funds on here for you to go through. The only other thing that I probably want to call out is that there are a few additional accounts on here. So we've got a personal pension account, as well as a junior ISA account if you've got kids which you want to invest for. And the only other thing that I wanted to call out is around the fees on this platform itself, which I believe is 0.2%, but I will just double check. So just finding out that fee now, guys, you can see it's actually 0.15% is the annual account fee, which allows you access to all of the 70 different funds, and you can invest from as little as £100 per month or lump sum instead. So that is the Vanguard platform. Obviously, there is tons more information on here. Certainly suggests that, if it's a broker which you're interested in using you go into a lot more detail in terms of the research and kind of looking into all the different funds, the performance of those funds, the diversification of those funds, and so on and so forth, in order to make sure it's the kind of best fund for you in terms of your personal risk appetite and investment objectives as well. So they are the two brokers which I predominantly use. Trading 2 on 2 for more individual stock investing, and then Vanguard UK for, I guess, more of you guys who want to invest into diversified funds and ETFs instead. However, it's probably worthwhile me saying that you can actually invest into some of these Vanguard funds over on the Trading 2 on 2 app as well. So the next thing that I wanted to talk about, as promised in a little bit more detail, is stock research and analysis, because this is, I guess, the foundation of your investment decisions, the kind of research, analysis, the due diligence which you do prior to making an investment. So because of that, it's super important to understand what kind of analysis in which you can do and what kind of research which you should be doing before making an investment. And of course, this isn't an exhaustive list, but we will go through some of them in a little bit more detail in terms of the individual ones in which I've called out. But first up, we've got two different types of analysis. The first one being quantitative analysis, which just simply taking a quote off Investopedia, is in finance an approach that emphasizes mathematical and statistical analysis to help determine the value of a stock. Sounds very complicated, but if I'm honest, guys, all of these mathematical and statistical analysis equations are always worked out for you on some of the websites and resources in which I'm going to show you in just a moment's time. However, these kind of quantitative analysis factors are things like the price to earnings ratio of a stock, price to book ratio, earnings per share, and there's many, many more in which you can look into. The second point of analysis is qualitative analysis, which is a method of analyzing companies based on factors that affect their intrinsic value. It determines the underlying health and performance of a company by looking at key numbers and economic indicators. Some of the key qualitative factors which you may want to research in more detail is the competitors within the market and how they stack up as a potential investment opportunity. The current market opportunity for the stock in which you're investing into. Is it a growing market? Is it a contracting market? Those are the kind of things which you're probably going to want to know about. And then also just innovation as well as research and development. How much money is the company investing back into its own operations in order to facilitate future growth? So there are a few key metrics which we can certainly look at in a little bit more detail. So first up, what I wanted to talk about is the price to earnings ratio. So the price to earnings ratio compares the company's share price to the company's earnings per share. Or in other words, it's the price in which you are prepared to pay for each dollar or pound in earnings in which the company generates. Now, at the bottom of the screen, you can see a little bit of a graph. And this is simply the price to earnings ratio of the S&P 500 over the course of the past, 100 odd years, which has actually been adjusted for inflation. And you guys can see that the average price to earnings ratio of the S&P 500 is actually 15.86. So that kind of gives us a little bit of a benchmark in terms of where the stock market is, whether it's overvalued or undervalued, and can kind of give us a little bit of an insight to looking at individual stocks and how they kind of stack up to the wider index. So as of right now, you can see that we're very much in overvalued territory with the current price to earnings ratio, inflationary adjusted, at 38.63, which is pretty much nearly as high as it's been since the dot-com bubble of the early 2000s. And this is why you'll see kind of comments in the media around stocks being in a bubble and the stock market being in a bubble, which potentially could go on to burst in order to kind of get prices to come back down once again and trade at more of a fair value. But for now, that's just the way it is in the current market conditions in which we're facing into. Stock prices are historically overvalued, and we can see this just by looking at the price to earnings ratio of the S&P 500 today. The next thing that I wanted to talk about is a company's earnings per share. So it shows how much the company has made in earnings or profit, depending on the terminology in which you're used to, compared to the number of shares outstanding, which simply just means the number of shares in circulation. And it's widely used for estimating corporate value. Now, analysts typically report on earnings per share figures and calculate earnings per share forecasts and estimates rather than looking at bottom line figures, i.e. just what the kind of net profit of the company actually is. The reason why analysts look at an earnings per share is because it's relative. So that means by looking at an earnings per share figure, you can actually compare that to other stocks, perhaps other competitors, or perhaps other stocks within the broader industry. So at the bottom of the screen, you can see the earnings per share figure of companies like Amazon, Apple, Bank of America, Facebook, Ford, Google, Microsoft, Netflix, and Tesla. And on the basis of kind of earnings per share, you can actually see, I think it's Google is very much the top performer when it comes to the earnings in which they have for every share within the business at over $50. Then second up on the list is actually Facebook, a very high profit margin business. You'd probably kind of suspect Google and Facebook to be two very much at the top. And then a little bit lower down, we've got the likes of Amazon and Apple, which are far lower down on that earnings per share figure, obviously running slightly higher cost, lower profit margin operations. So that's earnings per share. As I said, there's a huge exhaustive list of quantitative factors which you can actually look into, but here are just a couple of additional ones which you may want to look into as well. So you've got things like the profit margin, which I've very briefly touched upon, which is essentially the profit per pound or dollars in revenue which is generated. Let's say, just for an example, if a company has an 18.6% profit margin, that means they're generating 18.6 cents in profit for every dollar generated in revenue. Bit of a typo on the screen there, that should say generated in revenue rather than generated in profit. Then we've got the price to book ratio, or the PB ratio, which essentially is just the market value of the company compared to that of the assets in which they have, or the asset value in which they have, which is in reference to the book value of the company's balance sheet. Book value under 3 is typically considered a good investment. Next up, we have the current ratio, which is just a comparison of the company's current assets versus that of the company's current liabilities. Now, the reason why the current ratio is important to look at is because it kind of gives us a little bit of an insight into how financially flexible the business is by looking at the metrics on their balance sheet. Ideally, in a personal preference for me is for a company to certainly have more current assets than they do current liabilities, because it means that they've got, in essence, things that can be liquidated into cash very quickly, which can pay for all of the financial obligations which the company has, which are due within the next 12 months. So, for example, a current ratio is typically seen as perhaps 1.5, which essentially means for every $1 in current liabilities the company has, they have $1.50 in current assets, which is obviously a healthy position to be in because they have a higher amount of current assets than they do current liabilities. The final metric to look at, especially for those of you guys who are interested in dividend investing, is something called a payout ratio, which in essence is the percentage of a company's profits which they actually go on to pay out to their shareholders via the means of a dividend. So, for example, a 94% payout ratio literally means that the company will pay out 94% of the profits in dividends to its shareholders. Now, you might be asking, well, where can I find out a little bit more information about doing, quantitative and qualitative analysis? And here are a few resources which I've personally used just from doing my research. So Yahoo Finance is a really good one, and I'm going to dive into Yahoo Finance and do a little bit of a live stock analysis on a stock in just a moment's time. You've got investor relations websites, guys. So every company will have an investor relations website whereby investors like me and you can go onto the website. We can get all kinds of details on the company's strategic direction. You can get information on their SEC filings. You can get so much information on there which will give you lots and lots of breakdown on the business itself to give you a full understanding of the business. Because as Warren Buffett said, you should never invest into a business which you don't understand. So it's always wise to kind of do a little bit more digging on the business itself, how it operates, how it functions, how it makes money, and how it can actually provide you a return on your investment. Then simply, we've got Google. Google is your best friend for absolutely everything. Everything which I've shared with you guys during this video so far, you could have simply Googled and got all of the information yourself just by doing a few simple Google searches. Do the same for all of your stocks in which you plan to invest in as well. Get as much information, as much detail on these stocks as you can in order to do all of your due diligence and all of your research. And then finally, I've put CNBC on here. The reason why is because I do typically like to look at the news headlines, especially CNBC, because it's more business focused and more stock focused, more investment focused. In comparison to perhaps the BBC News as an example, I find CNBC far more valuable from just keeping me up to date with kind of movements in the stock market, investor sentiment, and kind of what's going on with all different kinds of businesses. So there's some key resources to bookmark on your web browsers. But for now, what I wanted to do before we talk about the next thing on the agenda is to actually do a little bit of a live stock analysis. So guys, up on screen, we have Yahoo Finance. And what I'm going to first do is at the search bar, I'm going to type in the ticker symbol of the company, which I want to do a little bit more research on today. And that is Apple, because it's one of the holdings within my own investment portfolio. So let's share with you guys all of the details which actually come up about Apple as an investment. So over on the left hand side of the screen, you can see Apple, the ticker symbol AAPL. You can see the current market price of $176, which is up 0.23% today. Moving down then over onto the left-hand side, just as highlighted here, you can see the kind of previous close for Apple stock price. When the market closed, you can see the open price. You can see the bid and the ask, which are kind of a little bit less relevant, if you like. Probably the next key thing to call out is the 52-week range, which gives you basically the market low price of Apple over the course of the past 12 months, and then the market high price, because that can kind of give you a little bit of an indication as to how close the stock is trading to 52-week highs and all-time highs in some cases, versus that of kind of 52-week lows and the absolute low price of the market. Then next up, you've got the market capitalization of the company. Apple is the biggest company on the planet today with a market cap close to $3 trillion, which is just absolutely massive. Next up, we've got the beta of the stock, which is 1.2. Now, the beta essentially is the volatility of a stock compared to that of the broader index. So a beta above 1 is slightly more volatile than that of the broader index. A beta lower than 1 is slightly less volatile. So again, kind of just weigh that up within your own risk tolerance and your own kind of appetite for fluctuations within your investment portfolio. Bear in mind that Apple is a little bit more volatile than just the broader market itself. Next up, we've got the price to earnings ratio, which we've just touched upon at 31.38, which is actually slightly lower than that of the S&P 500 price to earnings ratio today. Earnings per share as well, generating $5.61, which again is all pretty good. Then we've got the dividend yield of 0.5%. For all of you dividend investors out there, you do get a little bit of a dividend too. Then over on the right hand side, just a couple of key things that I also like to look at is you can look at the earnings per share. Remember how I said analysts kind of forecast earnings per share before they come out, and you can kind of see that Apple has been beating expectations over the course of Q4 2020, Q1 2021, and Q2 2021. They were bang on with Q3 2021, and of course Q4 we are yet to find that out. We'll go wait to the January 25th in order to be able to get that information. Then financials in a graphical format, you can see either on an annual or quarterly basis. A revenue actually looks like it's dropping off quite substantially over the course of past few quarters or so. Hopefully we'll get a bigger Q4 in order to finish the year off strong. But you can see very much steadily growing revenue over the course of the past 4 years for Apple, along with growing profits too. The next thing that I want to call out, guys, is the let's go on to the statistics tab first, because this gives us a little bit more information around some of the quantitative analysis metrics which you can actually look at. Now, I'm not going to go into them in all of their entirety, but remember how I said you don't have to work anything out anymore from kind of the mathematical perspective, is because it's all literally done for you on websites like Yahoo Finance. So again, got the market cap, enterprise value, we've got price to sales, price to book, we've got the price on earnings growth, we've got enterprise value to revenue, enterprise value to EBITDA. Again, we've got profitability, so profit margins, which we've discussed at 25.8, pretty healthy stuff. We've got return on assets, return on equity, very strong return on equity of 147%. Then you've got revenue, quarterly revenue growth rates. Again, if you're looking to invest into growth stocks, obviously you want to see huge growth rates quarter on quarter. Apple very much performing well at 28.8%, which is just huge. Earnings growth rates, again, very important for those of you guys who are looking to invest in stocks, which you're hoping will grow in value over time. 62.2% growth for Apple over the course of the past quarter. Then you can see a little bit more information about the balance sheet. We've got cash, debt, current ratios, which we've discussed. And down at the bottom, we've got the cash flow, with operating cash flow, and so on. Then over on the right-hand side, probably not much which I really want to call out, if I'm honest, guys. Probably the key things is there is a payout ratio around here somewhere, which we spoke about. Where is that payout ratio gone? Oh, here's the payout ratio. So you can see Apple only actually pay out 15% of their profits to their shareholders currently. So there is huge scope to actually increase that dividend over time, as Apple probably invest less back into their business, as it gives us currently a good opportunity to for that dividend to be increased. And that's probably about it from the kind of statistical perspective. The final thing to probably go through is just the financials in a little bit more detail. So we've got things like the income statement, which is a breakdown of all of the revenue, all of the cost, all of the operating costs. Gives you an earnings per share figure as well at the bottom, as well as a net income figure, or earnings before interest, tax, depreciation, and amortization. Again, good and useful to look at. This is not actually the best visual representation. Probably better off to go on to the company's proper filings, which, as I said, you can get on the investor relations website to dive into these financials in a little bit more detail and kind of compare them year on year. Next up, you've got the other key financial statement, which is a balance sheet, which compares the company's total assets versus that of the company's total liabilities. In an ideal world, a company will have more assets on the books than they do current liabilities. Apple, I think they very much sit cash heavy as well. If I'm honest, yeah, they've got an absolute ton of cash on the books. You can see the full breakdown, as you guys can see. And again, these numbers are all quoted in thousands, so huge, ridiculous numbers in terms of what Apple have, in terms of the money they have. And then as well, you can break that down to have a look at the cash flow. Again, this is an important thing for growth stocks, more specifically, those up-and-coming stocks. See what their cash flow position looks like. Are they financially secure? Will they be struggling for cash flow? It was one of the big critics around Tesla earlier on in their early days, around not having sufficient cash flow to fund the operations within the business. So they are the three core financial statements. Super important to understand these in more detail. Obviously, I'm by no means an accountant. I don't know all of the ins and outs of all of these three different financial statements, but I kind of do have a pretty decent understanding of income statements and balance sheets and cash flows. So again, do a little bit more research on all of these financial statements which you have. So having discussed investment analysis in a little bit more detail, the next thing that I wanted to talk about is actually investment strategies. So the first one that we're going to talk about is timing the market, because it's a thing that everybody feels is probably the best thing to do, but is actually the most difficult. And because of that, I've simply headlined this slide by saying time in the market is better than timing the market. So simply just having an investment, holding it out for the long term, is actually more effective most of the time than kind of buying and selling in order to kind of get in at the lows of the market and then selling in at the highs and then trying to get back in when the market comes down and all that kind of stuff. It gets very, very confusing and complicated when you try and do that on more of an active basis. So because of that, as I've said, timing the market is virtually impossible to do consistently for a long period of time. And research actually shows that those who just stay invested, i.e. just buy an investment, hold it forever over the long run in a well-diversified portfolio, will generally do better than those who try to profit from turning points in the market. And you can see a bit of a statistic here. So the 20% of least active traders, those are just completely passive investors, have an average annual portfolio return of 18.5%. Versus the 20% most active traders who actually have an average portfolio return of just 11.4%. So there's a 7.1% difference per year based on how active you are within the market. So ideally, for the vast majority of people anyway, you're better off just investing, being quite passive about it, and kind of progressively building your investment portfolio over time, rather than kind of looking to buy and sell based on turning points in the market. Which leads me on to talk about the next investment strategy, which is lump sum investing. Now, lump sum investing is what it says on the tin. It's investing a large sum of money into the market all at one time. And you may want to consider potentially doing this if you have a big retirement fund, a large pot of cash savings which you want to get to work, or perhaps even inheritance, whatever it may be. However you've come into a large sum of cash, you may want to consider investing it in a lump sum. However, Whilst investing in a lump sum payment is typically favorable for some people, some additional considerations which you should probably make before doing so is your risk tolerance, because having a huge amount of money invested into the market all at one time certainly has a little bit of an emotional component attached to that. Similarly, we don't know the immediate future of the stock market nor the investment in which you've made. So you may, your portfolio may actually go down in value before it actually goes up. And because of that, you could buy in at the absolute peak of the market and we could see 12 months of price depreciation rather than price appreciation. So because of that, your investment portfolio could be quite volatile. And if you've got so much of an emotional attachment to that large amount of money, might not be the best idea to lump sum it all at one time. As I said, potential for bigger fluctuations in the short term, whilst the market can be quite volatile at times. And as I said, the value of your portfolio may go down before it goes up. So because of that, what I next wanted to touch upon is cost averaging into the market, which is a simple alternative. It's the investment strategy which I personally use. And in essence, it's a means of investing into the market during regular time intervals. And in essence, what you can see is the green dots provide a visual representation of all of the investments which I made over on my Vanguard account. So you can see over the course of a 2 or 3 year period, I just regularly invested into the market every single month and grew that portfolio over time. So why on earth would you cost average into the market if you've got all of the money available at once? Why would you wait, 12 months or 24 months or 36 months to put that money into the market? Well, simple answer is you either don't have a lump sum available to you. You want time diversification within your investment portfolio because, as you can see from the screenshot in front of you, obviously the market fluctuates over time. Thirdly, it reduces the emotional component of investing. And fourth and finally, it mitigates unfavorable market timing. As I said, you don't want to invest at the absolute peak of the market with all of your cash savings, and instead, you could cost average instead and cost average over the course of a few months or a few years or whatever you're most comfortable with. So with that all in mind, what is actually the best investment strategy? Lump sum investing or cost averaging? Well, typically speaking, lump sum investing does outperform cost averaging. Couple of studies which I've just found. One study done by 2 professors of finance in the early 90s looked at historical stock market data spanning around 70 years. Their findings showed that around 67% of the time someone invests a large lump sum of money gained higher returns in their first year than someone who followed dollar cost averaging and drip fed their investment over the course of the same period. Then secondly, another study which was done more recently by Vanguard looked at the difference between dollar cost averaging and lump sum investing by investing into a 60-40 stock bond split portfolio, which I referred to as those life strategy funds, in 3 different countries. They found that in each market, a lump sum investment led to a greater portfolio value approximately 2/3 of the time. So the results are very, very consistent from these 2 different studies. The lump sum investing does typically outperform cost averaging. However, both of them have their pros and cons. So hopefully that gives you guys a little bit more of an insight into what investment strategy you should go with based on your own personal circumstances. But what I wanted to kind of talk about next is why you should actually invest as soon as you possibly can. And the simple matter of fact is, as Albert Einstein said, the compound interest is the 8th wonder of the world. And it's very, very true when you look at it from an investment's perspective. When you compare just these 2 examples, which I've got on screen in front of you. So scenario A is a 20-year-old person who has a target retirement age of 60 and has an investing time horizon, therefore, of 40 years. That individual invests a £1,000 principal, let's say on his 20th birthday or her 20th birthday, and then makes £400 monthly additions over the course of their investing lifetime, accounting for inflation too. Providing an average rate of return of 7.5%, which is a little bit lower than the average returns which I shared with you guys at the start of the video. Over that 40-year period, in scenario A, this person would have got an investment portfolio of just over £1.5 million. However, in scenario B, someone who started investing at age 35 with a retirement age of 60, only having just 25 years to invest with the same principal, the same monthly additions and the same return on investment, would have only less than 1/3 of the portfolio size after 25 years of just £425,000. So hopefully that just gives you guys a bit of a visual look of why it's so important to invest as early as you can and for as long as you can in order to maximize the returns within your investment portfolio, because the longer you can invest for, the compound effect will start to do the work for you. And you only have to kind of look at the net worth of the individuals like Warren Buffett to see the compound effect truly in action. So with that in mind, one other consideration which you're certainly going to want to make is how much should you actually invest? Now, there are some considerations which you should make before you even consider investing into the stock market whatsoever, and they are that you should certainly have a cash emergency fund in place, ideally covering 3 to 6 months worth of your monthly expenses before you then go on to invest into the stock market, just to make sure that you're financially secure and that you actually don't need the money. Then allocate a percentage of your disposable income that you're comfortable with. Perhaps it's 5%, 10%, 15%, whatever that may be. And then finally, just don't invest any money that you may need within the next 3 to 5 years. The last thing that you want to do is kind of put your house deposit into an investment portfolio, and then for the investment or the stock market to crash 20 or 30%, and then you being sat years away from potentially being able to buy your first home. So just bear that in mind. Then finally, the reasons why you shouldn't invest, and I probably can't stress this enough, investing into the stock market or investing in general is not a mechanism to get rich quick. It's not a mechanism to recover from financial loss, and it's certainly not a mechanism to get out and it's certainly not a mechanism to get out of financial struggle. So it's important that you get those 3 points at the top of the screen right first in order to get yourself financially prepared, financially secure, financially stable, in order to then be comfortable to go on to invest into the stock market. Then finally, let's talk about some actionable steps which you can take from watching this video right the way through to the end. Hopefully you made it right the way through with me. But actionable steps. Firstly, set up a brokerage account. I'll leave a couple of links, guys, down into the description below. It supports the channel as well if you do use those links, and you will likely get a free share depending on which one of those you use. When you sign up to brokerage apps like Trading 212 and Free Trade, you will get a free share when you do sign up to those accounts. You then need to go on to then fund that account, then do all of your research and due diligence prior to making an investment. Then, once you've done all of that and you've spent a decent amount of time understanding the investment which you're about to make, you can then go on to buy your first stock or perhaps ETF if you're interested in investing into the S&P 500 as an example. And then finally, consult a professional. I'm just a YouTuber, just a random guy on the internet. Be sure to consult a proper professional if you're unsure about any of the investments in which you're about to make or just investing in generally. So that said, guys, I hope you did enjoy this free course. If you did so, be sure to drop a like on the video, guys, as well. Subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.